Hello everyone, this is Group A13. In this walkthrough, I will demonstrate a RoboAdviser style platform we built for our financial modeling project. The idea is to connect three layers in a single user journey. First, we estimate asset moments, expected returns, and a covariance structure from selected 10 asset and price series, and we keep an Excel workbook in the loop as an independent check on those inputs and on the classic portfolio objects you would teach in a classroom, the global minimum variance portfolio, points on the efficient frontier, and utility-based optima. Second, we use a multi-turn risk interview to map how someone feels about risk and horizon into a scalar risk aversion coefficient on a bounded interval. That coefficient is the only bridge we need from psychology to math, which keeps the system auditable. Third, a Python backend, FastAPI, NumPy, and SciPy, performs the constrained mean variance optimization and returns not only a recommended long-only weight vector, but also the efficient frontier and reference portfolios for visualization. The Next.js front end renders the frontier, optional benchmark markers, and a clear allocation view with a pie chart and a table. I will not walk through the implementation stack line by line. What matters in this video is the end-to-end story from data through preferences to numbers you could explain to a client or a grader. When you are ready to follow along, I will move from this page into the data side, and then I will re-enter the product from the home screen. Let me anchor the math in the data. The raw files are time-aligned price or NAV history for a diversified fund universe. In the processing pipeline, we work in log returns at a monthly or consistent frequency. Then we annualize the mean and the covariance the same way the course specification and the Excel model use. So the inputs the optimizer sees in Python and the inputs in the spreadsheet are the same object, not a rescaling that diverges only in code. The vector of expected returns and the covariance matrix are the only objects you need to start Markowitz's problem in this form. The feasible set of portfolios that satisfy the budget constraint, weights summing to 1 and the long-only bounds, defines a set of possible pairs, expected return versus volatility, and the efficient subset is the part of the boundary where you cannot increase expected return without taking more volatility at the margin. The Excel book exists so that a reviewer with a spreadsheet can rederive the same moments, run the same constraints in Solver, and see whether the service layer is a faithful numerical twin within standard floating point tolerances, not a hand-waved machine says so. I will not quote those tolerances in the voiceover. The written report and the reconciliation output cover that. With the inputs and the audit philosophy in place, I return to the product and show you how a user would actually use it, starting from the home page. This is the product home. From here, the user follows a linear story. Complete the risk interview, then inspect where the model places them on the efficient frontier in risk and return space, and then open the portfolio view to see names and weights that add up to a full investable story. I will first take the system through that path with answers that I designed to be very conservative. Shorter effective horizon, low tolerance for drawdown, defensive behavior under stress, and the like, so you can see a cautious profile, the frontier location, and the resulting allocation. I will then repeat the same pipeline with a more aggressive answer pattern. The market data in the backend is identical in both runs, only the elicited risk aversion changes. I am starting the assessment now. A retail user does not type a risk aversion parameter into a form. The system holds a small number of dimensions that investment conversations already care about. For example, how long the money can stay invested, the maximum drawdown the person can live with, how they would react in a market crash, the stability of income, and a rough level of market experience. Each dimension is scored on an ordinal scale, and those scores merge into a single composite that the platform maps into a continuous risk aversion on a closed range. The mapping is rule-based in our project, not a one-off guess by the model, so the same answer pattern always yields the same internal coefficient, which is what we want for grading and for debugging. The economic meaning is the standard mean variance utility story. A higher aversion to risk makes the variance term in utility matter more, so the optimizer shifts the solution toward the left end of the feasible frontier, where the portfolio is less volatile at the cost of a lower expected return. I did not pre-announce the number you see on the screen because the exact value is not the story. The stability and interpretability of the path is. I will now use this conservative profile in the next two screens, first the efficient frontier, then the allocation. This is the mean variance picture in 2 dimensions, which is the language every finance student is trained in. The horizontal distance is the total risk of the portfolio in this one-factor summary, the annualized volatility of the portfolio return, not a security by security list. The vertical position is the expected return from the same annualized vector we estimated from the history. The curved locus is the long-only efficient frontier under the product's default bounds. For each level of vol to the right, the points on the curve are the best combinations of the funds, in the Markowitz sense, at that level of risk. You could not get the same or higher return at lower risk by mixing these funds differently while respecting the same constraints. The color scale is a visual ranking of how much return you earn per unit of total risk above the risk-free level we feed into the model, which the chart may show as a small constant in a note or a tooltip. I want to be careful about a few symbols that are easy to confuse. The global minimum variance marker is the leftmost fully invested long-only point on the curve, the portfolio with the lowest variance we can get without using leverage, which is a natural reference for safety in sample. The tangency marker, often distinct in color or shape, is the portfolio on the long-only frontier with the best excess return per unit of total risk, which in the textbook is where the line from the risk-free rate to the risky set would touch the frontier. Our recommendation is different from that in general. The optimal star is the point that maximizes the utility that uses your elicited aversion, which trades off the mean and the half aversion times variance in the way you have seen in the course notes, so the star is not guaranteed to be the same as the tangency when someone is not a pure return per unit risk maximizer in that narrow sense. A dashed line from the vertical axis, from the level of the risk-free rate through the long-only tangency to the right, is the capital market line. Any mix of the riskless asset and the tangency portfolio in theory traces that line. The practical path we are selling is a feasible long-only mixed fund portfolio with no separate levered cash line in the product, so your optimal marker belongs on the curved frontier, not on that CML, unless the product is explicitly set up to hold cash, which in our demo is not the focus. The right-hand column repeats return, volatility, and a Sharpe style ratio for the user optimal and for the global minimum, so a viewer can compare the recommendation to the least variance point at a glance. A utility readout is the value of the objective you ask the solver to maximize for that aversion, which ties the same formula you put on the front board to what the backend is actually optimizing. A short metadata strip records the sample window the moments came from, which is good scientific hygiene. We are not pretending that these moments are eternal truths, only that they are consistent between Excel and our engine. I will now go to the portfolio screen and translate the same optimal point into weights you can name. The frontier told us where the investor sits in mean variance space. This page is what to own. The pie gives the shape of the bet at a glance, where the mass sits across sleeves. The table is the line-by-line evidence, fund names, asset class when we show it, and each line's share of a long-only, fully invested book that also respects the same per-asset caps the optimizer used, so you should never see a single name above the configured cap. I will speak to the pattern of this first run, not every cell, because your exact weights may differ from mine. After a conservative elicitation, I expect a story with heavier weight in diversified dampening line items in the set, broad fixed income and similar, and lighter emphasis on a pure global equity one-shot bet, and a tighter distribution when the point on the frontier sat closer to the low volatility region. The substantive claim is that these are the unique long-only utility maximizing weights implied by the same problem you just saw in the figure, not a hand-picked theme portfolio. Bookmark this picture mentally. The next time we show both screens, we will have changed only the interview answers and therefore the elicited aversion, not the market data files, and you should see the shift in both the user's optimal point and the pie. I am running the assessment a second time with a clearly more aggressive answer pattern, while the raw price history in our files and the same annualized mean vector and covariance matrix that feed the optimizer are unchanged. In theory, what changes is the single scalar the mapping injects into mean variance utility maximization. A less risk-averse reading relaxes the penalty on return variance, so holding the feasible set fixed, the solver should place the user farther to the northeast on the long-only frontier than in the cautious first pass, meaning both higher expected return and higher total risk in a rough sense. The interface should show a more risk-seeking label and a coefficient toward the more aggressive part of the allowed range. I will not turn this into a race over every score field. The point of the rerun is to show that the same deterministic pipeline from answers to parameters to solutions can be exercised twice with a visibly different outcome on the next two screens, while the data layer stays fixed. On the frontier, the data-driven opportunity set is the same. The full frontier sweep, the global minimum variance and tangency references, and the single fund dots should stay in place because the moments did not change. The moved object is the user's utility maximizing point and the numbers next to it in the sidebar because a less risk-averse taste applies a smaller variance penalty in the same objective, and the maximizer slides the solution up and to the right along the long-only boundary in the usual way, grosso modo higher mean and higher total risk than the cautious case. The comparison you want on tape is first run optimum versus second run optimum, not tangency moved. Tangency is not a function of the interview. On the allocation page, the fund list is the same. The order and the size of the largest weights should lean more toward the higher beta and broad equity or regional growth sleeves the universe allows, if the data and the new aversion jointly imply that. The cautious versus aggressive contrast on unchanged inputs is what the exercise is designed to show. With that, the end-to-end path is complete. To close, our RoboAdviser is the web app you have been watching in this video. It uses real fund data to build the return versus volatility view and a suggested allocation the class teaches. A short risk questionnaire maps answers into a taste parameter the model can read. The submitted work also includes a spreadsheet companion so the same outputs are easy to check a second way. Thank you for watching this demo video.